Okay, so if you're already kind of comfortable with investing, you've probably heard terms like unit trusts, maybe investment trusts,
Yeah. And OEICs, too, open-ended investment
right?
companies.
OEICs. They get thrown around quite a bit. And look, they're not just jargon, are they? They represent, well, actual ways to grow your money, ways beyond just picking individual stocks yourself.
Exactly. They're structures, really.
But what really sets them apart? How do you figure out which one might actually align with what you want to achieve financially?
That's the core question, isn't it?
So today we're doing a deep dive into these collective investment schemes or pooled investments.
Hmm.
We want to really unpack how they work, what the advantages are, and maybe some of the pitfalls too. Things every investor should probably understand.
Absolutely. At their heart, these collective investments, they're just arrangements allowing lots of investors, maybe like you, to pool their money together.
Pooling resources.
Precisely. They come together to aim for a common goal. And they're particularly appealing if you feel you maybe lack the time, or perhaps the specific know-how, maybe the confidence, or just the experience to invest directly by yourself.
Makes sense. So our mission for you in this deep dive is to really get why these are popular, explore the main legal structures you'll see, and sort of grasp what each one could mean for your own financial journey.
That's the plan.
So let's start right there. Why do these collective investments appeal so much to you, the individual investor? What's the big draw?
Well, it's interesting because they offer several really key advantages that are, frankly, hard to get investing totally on your own.
Okay, like what?
First off, you get access to the services of a skilled investment manager, professional expertise.
Right, someone who does this day in, day out.
Exactly. And crucially, the cost of that expertise is shared among all the investors, so it becomes much more affordable than hiring your own manager.
Okay, that's a big one.
It is. And it also means you don't need to spend hours doing company research or grappling with, complex buy-sell decisions or handling all the administrative stuff that comes with it.
Paperwork.
That's right. Second, and this is really critical, your investment risk is significantly reduced through diversification.
Ah, diversification. The golden rule, some say.
It's fundamental. The investment manager spreads the fund's money across many different companies, maybe different sectors or countries too. So if one investment performs poorly or even fails, it only affects a small part of your overall investment.
So you're not wiped out by one bad bet.
Precisely. And there's another angle. Because these fund managers are handling huge sums, often millions of pounds, they can negotiate lower dealing costs when they buy and sell investments.
Okay, economies of scale.
Exactly. And those savings benefit all the investors in the fund. Then there's just the sheer choice available. There's a massive range of funds catering to almost any investment strategy or risk level you can think of.
So lots of options.
Loads. Plus, these schemes allow you to get exposure to assets that might otherwise be inaccessible because they have really high minimum investment sizes. Think about certain corporate bonds, for instance.
Right, you might need £100,000 to buy one directly, but you can get exposure through a fund with much less.
That's exactly the idea. It opens doors.
That all sounds incredibly appealing, especially, as you said, if you're short on time or maybe don't have huge amounts of capital to start.
Yeah.
But let's linger on diversification for a moment. It's talked about so much. How does it actually work in practice to, cushion the blows when the markets inevitably get a bit rough?
Yeah, it's a good question. Diversification, practically speaking, means building a portfolio that's spread out
Spread out how?
across different things, different geographical areas, UK, US, Europe, Asia, different types of assets. So shares, bonds, property, maybe commodities, and also across various economic sectors like tech, healthcare, finance, consumer goods.
Okay, spreading the risk widely.
That's the aim. The basic idea is that if one part of your portfolio hits a rough patch, hopefully another part is doing okay, or maybe even well, to help offset those losses.
Right.
Think of the old saying, don't put all your eggs in one basket. It's the exact opposite of that.
Can you give an example?
Sure. Imagine you only invested in, say, a company that sells sunscreen. You might do brilliantly during a really hot summer.
Makes sense.
But what happens during a rainy year? Your investment could suffer. Now, if you also held shares in a company that makes umbrellas,
Then you're covered whatever the weather.
pretty much your overall portfolio is less volatile because the different parts react differently to the same conditions. That's diversification in action.
That eggs in one basket or sunscreen and umbrellas analogy really helps clarify it. But, for someone listening who maybe feels they're quite good at picking individual winners,
Yeah.
How compelling is diversification really, especially when the market's going up strongly in a bull market?
That's a fair challenge. Even in a rising market, though, diversification is still crucial. It's fundamentally about managing risk, not just about chasing the absolute highest returns.
So it's about defense as much as attack.
Exactly. Look, nobody can consistently pick every winner year after year. It's just not possible. And even a single unexpected event, a company scandal, a regulatory change, a sudden downturn in a specific sector can seriously damage an undiversified portfolio.
So it protects against those sudden shocks.
It aims to, yes. Diversification is about striving for more consistent, smoother growth over the long term by evening out those inevitable bumps in the road. It's really a strategic move to protect your downside while still participating in potential growth. It's about resilience.
Okay, that makes a lot of sense. It's about the long game. So we understand why these collective funds are appealing: the management, the diversification, the access. But for many listeners, the next question is bound to be, okay, which type should I choose and how are they actually put together? Let's pull back the curtain on the main legal forms you're likely to encounter. Shall we start with the classic unit trust?
Sounds good. Unit trusts are, well, probably the most traditional form of collective investment in the UK. They're a pooled investment set up under something called a trust deed.
A trust deed. Okay.
Yeah, and basically you, the investor, pay a manager who then tries to achieve a better return on that pooled money. Think of it as the sort of quintessential mutual fund idea. You're buying into this collective pot, getting professional management and instant diversification.
Got it. And are there different kinds?
There are. They're typically classified in two main ways. You have equity trusts, which, as the name suggests, mainly invest in company shares.
Yeah.
And then you have fixed interest trusts, which focus on assets that yield interest, like government bonds or corporate bonds.
Shares versus bonds, essentially.
Broadly, yes. And a key feature of unit trusts is that they are open-ended.
Open-ended. What does that mean?
It means the trust can actually create new units when people want to invest and cancel existing units when people want to sell.
So the size of the fund can grow or shrink?
Exactly. There's no fixed limit to the number of units in circulation, unlike, say, shares in a regular company. The fund expands or contracts based on investor demand.
Interesting. And you mentioned units. Are there different types of those too?
Yes. Typically two kinds. You have accumulation units, often called AC units. With these, any income generated by the fund's investments, like dividends from shares or interest from bonds, is automatically reinvested back into the fund to buy more units.
So it boosts capital growth.
That's the aim, yes. Compounding growth. The other type is distribution units, or Inc. for income. With these, the income generated is paid out to you, the investor, usually periodically, like maybe twice a year.
Okay, so ACT for growth, Inc. for income.
That's the general idea.
So if I'm buying into a unit trust, how does the pricing actually work? And how do I physically buy or sell these units? Is it like buying stocks on an exchange?
No, not usually like stocks on a public exchange. It's a bit distant. With unit trusts, there are often two prices involved when you deal directly with the manager. There's the offer price.
Yeah.
That's the price you pay when you buy units from the manager.
Okay, the buying price.
And then there's the bid price. That's the price the manager pays when they buy units back from you when you sell.
The selling price.
Right.
And are they the same?
Not always. The difference between the offer price and the slightly lower bid price is called the bid-offer spread.
Spread. I've heard that term.
Yeah. It typically covers some of the fund's transaction costs and maybe part of the manager's initial charge. Think of it like exchanging currency at the airport. You get a slightly different rate buying versus selling. It's often around, say, 3 to 5%, but it varies.
Okay. And how do you actually make the transaction?
You buy and sell these units directly from the fund management company, or often through a financial advisor or an online investment platform acting as an intermediary. They aren't typically listed and traded between investors on a stock exchange like shares are.
So you deal with the fund manager directly or indirectly?
That's right. Although it's worth noting some funds operate on a single price system now, closer to the OEIC model we'll discuss, where the spread is handled differently, perhaps through an explicit initial charge.
Right. And who makes sure these trusts are run properly? Is there regulation?
Oh, absolutely. Unit trusts are heavily regulated, primarily by the Financial Conduct Authority, the FCA here in the UK.
The FCA.
They set rules to protect investors. For instance, there are strict rules about diversification. A unit trust generally can't hold more than, say, 10% of its assets in a single company's shares for more than a temporary period.
So they enforce that don't put all your eggs in one basket rule.
They do. It's a core part of the investor protection framework.
And who's actually responsible for what within a unit trust? It sounds like there's a manager, but maybe others too.
You're right. There are two key parties involved. Besides you, the investor, there's the fund manager and the trustee.
Manager and trustee, what do they each do?
Okay, the manager is the one doing the active investment work. They manage the fund's portfolio, they value the assets regularly, they calculate and set those unit prices we talked about, and they handle the process of issuing units to new investors and buying back units from sellers.
So the day-to-day running and investing.
Exactly. The trustee, on the other hand, has a crucial oversight and safeguarding role. They're usually a separate entity, like a bank or insurance company.
What's their job?
Their job is to hold the actual assets of the fund, the shares, the bonds, on behalf of the investors. They make sure the manager sticks to the investment rules set out in the trust deed. They protect the investors' interests, approve any promotional materials, collect the income generated by the assets, issue unit certificates, and generally supervise the manager.
So the trustee is kind of like the watchdog for the investors.
That's a very good way to put it. They're there to safeguard the investors' assets and ensure the fund is run according to the rules.
Right, let's talk money then. What about the charges investors should expect with unit trusts, and how does the tax situation work?
Okay, charges. There are usually two main types to be aware of. First, there's often an initial charge. This might be built into that bid-offer spread we discussed, or it could be a separate percentage charge on the amount you invest, maybe somewhere between, say, 0.5% and 5%, though it can vary widely, and sometimes it's waived.
Okay, an upfront cost.
Potentially, yes. Then there's the ongoing charge, the most significant part of which is usually the annual management charge, or AMC.
AMC.
This is a recurring fee paid to the investment manager for running the fund. It's typically calculated as a percentage of the fund's total value each year, perhaps somewhere between 0.5% and 1.5%, again, depending on the fund. This comes out of the fund's assets, so it directly impacts your overall return.
Got it. Annual fee for the management. What about tax?
Taxation is important. First, the fund itself generally doesn't pay corporation tax on any capital gains it makes from selling investments. That's a key advantage.
Okay, tax efficient within the fund.
Correct. However, you as the investor are potentially liable for capital gains tax, or CGT, when you eventually sell or encash your units if your gains exceed your annual CGT allowance.
So tax applies when you take your profit out.
If the profit is large enough, yes. Now, for income, it depends on what the fund invests in.
Ah, back to the equity versus fixed interest distinction.
Exactly. If the fund is primarily invested in fixed interest securities or holds a lot of cash, any income distributed to you is generally treated as interest for your personal tax purposes.
Okay, like bank interest.
Similar tax treatment, yes. If, however, the fund is mainly invested in shares and equity fund, then the income distributed is treated as dividends.
Which have different tax rules.
They do. Dividend income has its own allowance and tax rates, which are often lower than interest income rates. The detailed tax calculations can get a bit complex, depending on your overall tax situation, but the key point is you'll pay personal income tax on the distributions you receive, based on whether it's classed as interest or dividends.
Understood. So professional management, diversification, regulation. But what about the risks? Are unit trusts completely safe?
No investment is ever completely safe or foolproof, and unit trusts definitely carry risks.
Such as?
Well, while the structure with the trustee overseeing the manager helps reduce the risk of outright fraud, the pooled nature means you, as an individual investor, have less direct control over the specific investment decisions being made. You're trusting the manager's expertise.
Okay, loss of control.
To a degree, yes. If the fund invests heavily overseas, then currency fluctuations can also impact your returns, either positively or negatively, when the value is converted back into pounds sterling.
Right, currency risk.
And perhaps most importantly, there's absolutely no guarantee that your initial capital will be returned in full. The value of the underlying investments can go down as well as up due to market movements.
So you could get back less than you put in.
You certainly could. And there's also no guarantee that a particular level of income will be paid out, as dividends and interest payments can change. Market risk is always present.
Okay, that's a clear picture of unit trusts. Let's move on yet. What about investment trusts? You mentioned earlier they're different. How so? Are they similar in concept, or is there a really key difference?
Well, they are also collective investments, aiming to pool money, yes, but here's the crucial distinction. Investment trusts are not unitized in the same way as unit trusts.
Not unitized, okay.
Instead, they are actually public limited companies, PLCs, listed on a stock exchange. Their primary business, their whole reason for existing, is to invest in the shares of other companies, or sometimes other assets like property or bonds.
So there are companies that invest in other things.
Exactly. And because they are companies with shares traded on an exchange, they are close-ended.
Closed-ended, what does that mean compared to open-ended?
It means the number of shares the investment trust company has issued is generally fixed, unless the company actively decides to issue more shares or buy some back. Unlike open-ended unit trusts, they don't just create new shares every time someone wants to invest or cancel them when someone sells.
Ah, so the pot of money doesn't automatically expand or contract based on daily investor flows.
That's right. The capital base is much more stable. Investors buy and sell the existing shares from each other on the stock market.
Okay, so if I invest in an investment trust, what am I actually buying? And how does the pricing work if they're traded on an exchange?
You're buying actual shares in the investment trust company itself, just like you'd buy shares in, say, Shell or Tesco. You become a shareholder in that company.
Not units representing underlying assets, but shares in the investment company.
Correct. And because they're traded on a stock exchange, these shares trade at a single price at any given moment, determined by supply and demand in the market. You'll also pay standard stockbroking dealing fees and stamp duty when you buy them.
Single price, like a normal share.
Yeah.
How is that price determined?
Well, it's influenced by two main things. First, simple market supply and demand for the investment trust's shares. But second, and crucially, it's also influenced by the value of the underlying investments that the trust holds. This is called the net asset value, or NAV.
NAV, net asset value.
Yes, that's the total value of all the investments the trust owns minus any liabilities divided by the number of shares in issue. Now, here's where investment trusts get really interesting.
Go.
The share price on the stock market doesn't always equal the NAV per share. The shares can trade at a discount to NAV, meaning the share price is lower than the value of the underlying assets per share.
So you could buy £1 worth of assets for, say, 90 pence.
Potentially, yes. Or they can trade at a premium to NAV, where the share price is higher than the underlying asset value.
Why would that happen?
It's down to market sentiment, demand for the shares, perceptions of the manager's skill, the trust's dividend policy, or its ability to use gearing. Lots of factors. But this discount premium feature creates unique opportunities and risks for investors compared to unit trusts, or OEICs, which usually trade very close to their NAV.
You mentioned gearing. What's that?
Gearing is another key feature, particularly of investment trusts. It basically means the investment trust company can borrow money to invest on top of the capital raised from its shareholder.
Borrowing to invest more. Okay.
The idea is to enhance potential growth. If the investments bought with the borrowed money perform well, the returns for shareholders can be magnified.
Sounds good, but risky.
Highly risky. It's a double-edged sword. If the investments bought with borrowed money fall in value, the losses are also magnified, and the trust still has to repay the debt. So gearing increases both the potential upside and the potential downside. It adds another layer of risk compared to an ungeared fund.
Makes sense. Higher potential reward, higher potential risk. Are there specialized types of investment trusts too?
Oh, yes. There used to be things like split-level trusts, which had different share classes offering either income or capital growth over a fixed term, though they're less common now. More relevant today are things like real estate investment trusts, or REITs.
REITs, I've heard of those.
Yeah.
Property related.
Exactly. REITs are a specific type of investment trust, or sometimes other company structures, that invest primarily in income-producing property. They offer a way for you to invest in large-scale property portfolios, shopping centers, offices, warehouses, without directly buying buildings yourself.
And what's special about them?
Their main advantage is tax efficiency. Provided a REIT meets certain conditions, like deriving at least 75% of its gross income from property rent and distributing at least 90% of its taxable profits to shareholders, it generally doesn't pay UK corporation tax on its rental income or capital gains from its property business.
So more of the profit potentially flows through to investors.
That's the idea. Investors then pay tax on the income they receive, but the tax drag within the REIT itself is significantly reduced for its property activities. It makes them a popular way to get property exposure in an investment portfolio.
Okay, fascinating. Unit trusts, investment trusts. That brings us to the third main type, OEICs, open-ended investment companies, how do these fit into the picture? Are they like unit trusts or investment trusts or something else?
OEICs, pronounced OEICs, are sort of a hybrid in some ways, but lean closer to unit trusts in function. They are, as the name suggests, limited liability companies whose main purpose is to pool investors' funds.
So, like investment trusts, they're companies.
Yes, legally they are companies, but, and this is key, like unit trusts, they are open-ended.
Ah, so they can create and cancel shares based on investor demand.
Precisely. The number of shares in issue goes up when people invest and goes down when people sell, just like with units in a unit trust. The fund size fluctuates with investor flows.
Okay, open-ended like a unit trust, but legally a company like an investment trust. Interesting mix.
It is, and many OEICs are set up as umbrella companies.
Umbrella company.
Yeah, this means one single OEIC company structure contains multiple distinct sub-funds underneath it. Each sub-fund might have a different investment objective. One might be a UK equity fund, another a global bond fund, another a European smaller companies fund, all within the same legal OEIC wrapper.
So it's like a collection of different funds under one roof. Makes switching between them easier, maybe?
Potentially, yes. It can offer administrative convenience for investors wanting exposure to different strategies managed by the same provider.
And how are OEICs regulated?
They are established under regulations set by HM Treasury, and they must be authorized and supervised by the FCA, just like unit trusts. There's usually a corporate director responsible for managing the investments, dealing with the buying and selling of shares, and importantly, ensuring the share price accurately reflects the net asset value, NAV, of the fund's underlying investments.
Okay, so similar oversight to unit trusts. What about their pricing and charges? You said they trade close to NAV, like unit trusts.
Yes, generally. OEICs typically use a single pricing system. There's one price for buying and selling shares calculated directly from the net asset value per share.
No bid-offer spread like traditional unit trusts.
Usually not in the same way. The costs are often covered by explicit initial charges or are factored into the NAV calculation. Some OEICs also employ something called swing pricing.
Swing pricing. Sounds dynamic.
It is. Quite clever, actually. It's an adjustment mechanism. If there's a very large net inflow of money into the fund on a particular day, the NAV price might be adjusted slightly upwards, swung up. If there's a large net outflow, it might be swung slightly downwards.
I do that.
It's designed to protect the existing long-term investors in the fund. Large flows mean the manager has to buy or sell underlying assets, incurring transaction costs. Swing pricing aims to allocate those costs more fairly to the investors causing the flows, rather than diluting the value for everyone who's just staying put.
Ah, so it stops big movers from negatively impacting the steady holders.
That's the intention, yes.
Yeah.
In terms of other charges, you'll typically find an initial charge or buying charge, similar to unit trusts, perhaps 0.5% to 5%, although again, often discounted or waived by platforms. And there's an ongoing annual management charge, usually in that same 0.5% to 1.5% range.
Okay. And sometimes a dilution levy.
Yes, similar concept to swing pricing, a charge that might be applied during periods of very large inflows or outflows to cover dealing costs and protect existing investors from dilution.
And taxation for OEICs. Is it like unit trusts too?
Pretty much identical, yes. The OEIC fund itself generally doesn't pay corporation tax on its capital gains. You, the investor, are liable for capital gains tax on your profits when you sell, subject to your annual allowance. And the income tax treatment depends on whether it's classed as an equity fund, paying dividends, or a fixed income fund, paying interest.
So, tax-wise, unit trusts and OEICs are very similar.
Very similar, yes.
And the risks involved with OEICs, are they comparable to unit trusts as well?
Yes, broadly comparable. You have professional management and diversification, which helps mitigate risk. But because it's a pool fund, you have less individual control over the specific holdings.
Right.
And as with any investment linked to markets, the value can go down as well as up, and there's no guarantee you'll get your original capital back. The risks are very much aligned with those of an equivalent unit trust.
Okay, that covers the big three: unit trusts, investment trusts, OEICs. We understand their structures, pricing, pros, cons. But you mentioned earlier the world of pooled funds is quite vast. What other forms, perhaps less common or maybe newer types, might listeners come across? Where do they fit in?
You're right. It is a broad landscape beyond those main three. We can probably group some of these other forms. First, you've got some, let's call them legacy products, which were perhaps more common in the past, but maybe less so now, thanks to things like ISAs.
Okay, legacy ones?
Yeah. Things like endowment policies. These were traditionally life assurance products that combine life cover with regular savings, designed to pay out a lump sum on maturity after a set term or on earlier death.
Right, often linked to mortgages years ago.
Exactly. Their popularity has waned a bit, partly because things like ISAs offer more flexibility and often better potential returns without the life insurance component necessarily being required. Then there are friendly society plans.
Friendly societies, sounds old-fashioned.
They have historical roots in self-help organizations, yes. These are specific tax-exempt savings plans. They allow you to save limited amounts, often over a long term, like 10 years or more, with some preferential tax treatment. They're often used for saving for children or grandchildren. They serve a niche purpose now.
Okay, so endowments and friendly society plans are still around, but perhaps less mainstream. What else?
Then you have collective investment vehicles, often provided by life assurance companies, typically based on unitized funds. A key example here is investment bonds.
Investment bonds, are they like corporate bonds?
No, confusingly named. They're not direct bonds. They're essentially single premium life assurance policies where your premium is invested into one or more underlying collective funds, often the same types of funds available as unit trusts or OEICs.
Ah, so it's a life policy wrapper around collective funds.
Exactly. They have certain features, like the ability to switch between the underlying funds within the bond wrapper, often without triggering an immediate capital gains tax charge, and rules around withdrawing capital that can make them attractive for certain financial planning scenarios, particularly for higher rate taxpayers.
Okay, interesting structure. Moving on, are there types that are more, say, high risk or specialized?
Yes, definitely. You might hear about non-mainstream pooled investments or NMPIs.
NMPIs. Doesn't sound like something for the average person.
Generally, no. These are typically high-risk, illiquid investments. Think things like investing directly in unregulated property developments, forestry schemes, or private equity deals through a pooled structure. They are not typically sold to the general retail public in the UK.
Why not?
Because the FCA generally prohibits their marketing to retail customers due to the high risks, complexity, and lack of standard protections. They're usually restricted to sophisticated investors or high net worth individuals who understand and can afford the potential losses.
Okay, so steer clear, unless you're in that category, know exactly what you're doing. What about structured products?
Right, structured products. These are quite complex. They are investment products designed to offer specific outcomes, often linked to the performance of an underlying asset, like the FTSE 100 index, for instance.
Specific outcomes.
Yeah.
Like guaranteeing your capital back.
Sometimes they offer a degree of capital protection, yes, perhaps promising to return your initial investment unless the underlying asset falls by a very large amount. Others might offer enhanced growth potential, maybe paying out several times the index growth, but often capped at a certain level.
Sounds complicated. Are there catches?
There are significant risks. There's counterparty risk, the risk that the institution issuing the product, usually a bank, could fail, and you might not get your money back even if the investment performs as expected. There's market risk, as the terms might mean you get back less than your capital if markets fall significantly, and inflation risk, even if you get your capital back after, say, 5 years, its real purchasing power will have been eroded by inflation. They require very careful understanding.
Definitely sounds like one to approach with caution. Okay, any other categories?
Finally, it's worth mentioning the things that help you manage all these different investments. Wraps and platforms.
Labs and platforms. These aren't investments themselves.
No, they're administrative services, usually internet-based. Think of them as online dashboards or frameworks that allow you, or your financial advisor, to hold and manage all your various investments, your ISAs, your pensions, your unit trusts, OEICs, even direct shares all in one place.
Ah, so like an online investment supermarket and filing cabinet combined?
That's a great analogy. They provide a consolidated view of your entire portfolio, offer tools for analysis, make it easier to buy, sell, and switch investments, and can help with managing taxes more efficiently, like using your CGT allowance across different holdings. They've become very popular, especially for people working with independent financial advisors.
Right. Brings everything together. Okay, that's a really helpful overview of the wider landscape. Now let's shift gears slightly and talk about some more recent evolving trends. First up, something we hear about constantly. Sustainable finance.
Yes, sustainable finance or ESG investing. It's definitely moved mainstream.
ESG. That's environmental, social, and governance, right?
Exactly. You'll hear it called socially responsible investing, ethical investing, or green investments too. The core idea is that these non-financial factors, environmental, social, and governance issues, can significantly influence a company's long-term performance and therefore should be considered in investment decisions.
Can you give examples of each? E, S, and G?
Sure. So environmental might cover things like a company's carbon footprint, its water usage, waste management, like how well it handles paper recycling, for instance, or its impact on biodiversity.
Okay. What about social?
Social factors relate to how a company manages relationships with its employees, suppliers, customers, and the communities where it operates. Think fair wages, working conditions, diversity and inclusion policies, data privacy, product safety.
Right. And governance.
Governance deals with how a company is run. So things like executive pay, board structure and diversity, shareholder rights, business ethics, its approach to taxation, does it pay its fair share, does it have a strong ethics code?
So investors are looking at these factors alongside the financials.
Increasingly, yes. The argument is that companies managing ESG risks well might be more resilient, more innovative, and ultimately more profitable in the long run. Plus, many investors simply want their money to align with their personal values.
Makes sense. Are there downsides or challenges to ESG investing?
There are considerations, definitely. One potential challenge is that actively excluding certain sectors, like fossil fuels or tobacco, can restrict portfolio choice and might potentially lead to less diversification if not managed carefully.
So it could limit your investment universe.
It could. Some argue it might also favor smaller or medium-sized companies over larger ones, depending on the screening criteria. Historically, some ESG funds have had slightly higher charges, although that's becoming less common. And a big concern has been greenwashing.
Greenwashing, meaning?
That's where firms might overstate or misrepresent their environmental or social credentials to attract investment without genuine commitment or impact. It's making unsubstantiated claims about being green or sustainable.
How are regulators tackling that?
Well, the FCA here in the UK has been very active. They've introduced new rules called the Sustainability Disclosure Requirements, or SDR. These include anti-greenwashing rules and are bringing in specific investment labels like Sustainable Improver, Sustainable Focus, and Sustainable Impact to help investors better understand what a fund is actually trying to achieve in terms of sustainability and how it plans to do it. It aims to bring much-needed clarity and comparability.
Okay, so more transparency is coming. That's good. Now, finally, let's touch on a topic that generates endless headlines. Crypto assets. What exactly are they for someone who's maybe only heard of Bitcoin? How do they work?
Right, crypto assets. At its simplest, a crypto asset is a digital representation of value or rights where ownership is proven and secured using cryptography, hence crypto. The first and most famous type are coins, like Bitcoin, which were designed primarily as a form of digital money or store of value, operating independently of traditional banks or governments.
Okay, digital money secured by codes. How does the ownership part work?
Typically, a user holds their crypto assets in a digital wallet. This wallet has two keys. A public key, which is like your bank account number that you can share for receiving funds, and a private key, which is like your secret PIN or password that proves you own the assets and allows you to authorize transactions. Lose your private key, and you effectively lose your assets.
High stakes then. And what's the technology behind it? Blockchain.
Yes, the underlying technology for most crypto assets is some form of distributed ledger technology, or DLT. Blockchain is the most well-known type of DLT.
How does blockchain work in simple terms?
Imagine a shared digital record book that's the ledger. Every transaction is grouped into a block. Each new block contains a cryptographic link to the previous block, forming a chain. This chain is distributed across many computers in a network. Because it's cryptographically linked and shared, it's extremely difficult, practically impossible, to alter past transactions without the network noticing. It creates a transparent, auditable, and supposedly immutable record of who owns what.
Okay, a secure, shared digital ledger. Got it. Now, with all this novelty and sometimes volatility, how is the UK regulating crypto assets? Is it still a bit of a Wild West?
It's definitely evolving rapidly, but it's moving away from being a Wild West. Until relatively recently, FCA regulation in the UK was primarily focused on anti-money laundering and counter-terrorist financing rules for crypto firms.
Right, AML and CTF.
Exactly. But a big change happened in late 2023. Crypto assets were brought more formally into the financial promotion regulatory perimeter under the Financial Services and Markets Act 2000, or FSMA.
What does that mean for investors?
It means that any firm marketing certain types of crypto assets to UK consumers, regardless of where the firm itself is based now, generally needs to be authorized or registered by the FCA or have their marketing approved by an authorized firm.
So more oversight on the marketing side.
Much more. And there are strict rules attached. These firms have to provide clear, fair, and not misleading information, including prominent risk warnings highlighting that crypto assets are high risk and you could lose all your money.
What kind of risk warnings?
Very explicit ones about volatility, complexity, and the potential for total loss. There are also new consumer protection measures, like a mandatory 24-hour cooling-off period for first-time investors in crypto assets.
A cooling off period. Interesting.
Yes, gives people time to reconsider before committing. Firms also need to conduct client appropriateness tests to check investors have the necessary knowledge and experience to understand the risks. And they need to categorize clients you generally need to be classed as a restricted investor, high net worth, or certified sophisticated to be marketed these products.
So trying to ensure people understand what they're getting into.
That's the aim. It's about adding significant friction and warnings before retail investors access these high-risk investments.
What about stablecoins? Are they treated the same?
Stablecoins are a bit different. These are crypto assets specifically designed to maintain a stable value relative to another asset, often a traditional fiat currency like the US dollar or the pound sterling.
So trying to avoid the wild price swings of Bitcoin. Exactly. They aim to provide stability, making them potentially more useful for payments or as a temporary store of value within the crypto ecosystem. Because of this potential payments use, the UK is bringing certain activities related to fiat-backed stablecoins, like their issuance and custody, when used for payments under FCA regulation as well, treating them more like regulated payment services.
Okay, so a distinction between stablecoins used for payments and the more speculative crypto assets.
Yes, regulation is becoming more nuanced.
Wow. We have covered a tremendous amount in this deep dive. We've gone from the basic appeal of collective investing through the nuts and bolts of unit trusts, investment trusts, OEICs, touched on other forms like bonds and REITs, and even explored the newer frontiers of sustainable finance and crypto assets.
It's a lot to take in, for sure.
So the big question really is, what does this all mean for you, the listener, trying to navigate your own financial path? How do you synthesize all this?
Well, I think understanding these different structures is genuinely crucial. Knowing their advantages, like getting that professional management, achieving diversification easily, but also understanding their specific risks, how they're priced, the charges involved, and the tax implications. It's all vital information.
Because it lets you make better choices.
Exactly. It empowers you to make more informed decisions that really align with your personal financial goals. Are you aiming for long-term capital growth? Do you need regular income? Or maybe a combination of both? Knowing how these different vehicles work helps you choose the right tools for your specific objectives and risk tolerance.
It's about matching the tool to the job.
Precisely. There's no single best option. It depends entirely on your circumstances and goals.
So, perhaps a final thought for you to consider as you reflect on your own financial journey. Beyond just thinking about how much money you might potentially make, maybe ask yourself how much direct control and day-to-day understanding you truly want over your investments. Are you comfortable delegating most of it, or do you prefer a more hands-on approach? And thinking about that might help clarify how these diverse collective schemes could fit or not fit into your personal investment philosophy.
That's a great point. It's about finding the right balance between leveraging expertise and maintaining the level of engagement you're comfortable with.